For our next session, I would like to welcome Ben Hughes, Director for Capital Projects at Deloitte Middle East, who will be setting the scene and providing an economic review and outlook.
Morning, everybody. Okay, so the 2016 economic outlook, I think it's fair to say for probably everybody in this room, it's been a challenging year to date. If we look firstly, you can see on the graph, or on the slide there, sorry, in terms of GDP growth, 2015 was recorded at 3.2%. The projection, according to Me Projects, for the end of this year is 1.9%. And the projection for 2017 reflects a slight increase up to 2.3%. So clearly, there is some bounce back in 2017 anticipated. If you look at that, if you baseline that to the US, for example, their forecast for Q4 2016 is 2.2% and 2.6% in 2017. So clearly, we're tracking comparatively well with the relatively buoyant US economy. As of yesterday, the oil price was $44 per barrel. I think it's 45 this morning. And that represents a 70 to 80% year-to-date recovery from the start of this year. So clearly, those prices are stabilizing. Clearly, there's been a slowdown in project awards across the Gulf, and that's a result of governments undertaking spending reviews. Obviously, the worst affected markets are Saudi Arabia, Qatar, and our near neighbours Abu Dhabi, whereas Dubai, Bahrain, and Oman seem to have fared more reasonably well due to their more diversified economy. In terms of the government's reassessing the priorities, clearly that's focused on reducing the dependence on oil revenues and hydrocarbon revenues. And that's borne out by programs of reform such as the Saudi Vision 2030, which in itself then has created the National Transformation Plan in Saudi Arabia. You've got the Qatar National Vision 2030 also. Governments are still delivering priority schemes, particularly in terms of infrastructure, social infrastructure, but they're also looking at alternative sources of income such as taxation, raising bonds, PPP models. There's also a greater reliance on the private sector as well. So again, raising debt via PPPs. Obviously, the PPP law was introduced in Dubai last year, I think. And there's obviously a reliance on private sector developers as well. And that in turn obviously relies on the construction market as well. So there's an increasing amount of UK export finance, by way of example, which is used here in the region. Contractors obviously bringing the finance to kickstart developments on behalf of developers. So there is an increasing importance on the private sector to drive economic recovery. There's still a challenging context for contractors, clearly. We've heard lots of press reports of contractors just not being paid, even though payments have been certified by clients. They just literally haven't got the money. Unfortunately, contractors are, under the contract, generally obligated to pay their subcontractors. They're obviously obligated to pay their staff, and as a consequence, if they're not being paid by their clients, there is a major impact on cash flow, which can be fairly profound. Slower decisions and less project opportunities as well create an even bigger impact. So in terms of the drivers for the construction sector, I think we probably all know them, but clearly the construction sector is a major driver for economic recovery, economic growth within any mature economy, but particularly in emerging economies such as across the Middle East. It's obviously fundamental to economic growth. Population growth is a key driver as well for a lot of government. So, transport projects, health, residential, power projects, these are all key to support the increasing population. It's also a young population as well, so there's a need to create jobs for a younger and younger economy, a younger demographic, and there's obviously a need to diversify, again, away from oil dependency. There's obviously localized drivers, such as we heard on the previous presentation, such as Expo 2020, We've got the World Cup 2022, and that's underpinned by tourism as well, which we can all see here in Dubai and also in Abu Dhabi as well. There's lots of diversification headed towards tourism projects. So hotels, we've got the Louvre in Abu Dhabi, and we've got the theme parks here in Dubai. In terms of how that looks, in terms of numbers, in 2015, there were $165 billion worth of contracts awarded. The prediction in terms of the outturn for this year, 2016, is 140 billion. In terms of year to date, we've had $31 billion of contract awards. In Q1, that's down 44% year on year. And in Q2, we've had $36 billion of contract awards across the GCC. And again, that's down 13% from this time last year. I think it's fair to say, looking at Q3, Q4, even the $140 billion prediction could potentially be optimistic. But actually, if you look at the graph to the right-hand side of this slide, you can see even if we hit the range of 120 to 140 billion, if you look at 2012 as a comparator, it still demonstrates net growth. So obviously, the picture isn't all doom and gloom. So is recovery on the way, I suppose, is the question everybody's asking. The total value of projects planned and underway across the GCC is $2.8 trillion. The vast majority of that is comprised of Saudi Arabia at 1.2 trillion, closely followed by Dubai at 850 billion. Clearly, Saudi is reassessing a lot of its priorities and looking at priority schemes around education, housing, and diversification. Obviously, the UAE, we all know what the UAE economy is driven by, but obviously tourism growth, major events, etc. Oman is focused on upstream projects, IPPs, airport expansion, and some tourism as well. Qatar is clearly focused on the World Cup 2022 and all of the infrastructure required for that. Kuwait is driven by transport and oil and power sector projects. And Bahrain, again, Bahrain is a relatively diversified economy. We understand there's $32 billion of projects coming on stream within the next 5 years, although they're heavily reliant on the finance sector as a diversification method. One of the key takeaways from this particular slide is of that 2.8 trillion, 2.1 trillion is actually projects in the pipeline. So clearly, the medium-term outlook and medium-term pipeline is relatively good. This slide just gives a very brief overview in terms of where each of the GCC economies are in terms of their level of maturity and their level of diversification. I appreciate it can be fairly subjective, but it is based on some on IMF data. And clearly you can see Bahrain and the UAE, very diversified economies that are accelerating away from the other GCC economies. And that's something that a lot of those other regions, such as KSA, etc., are acutely aware of, and they're obviously striving to arrest that. So how have we passed the worst of it, I guess, is the key question. There's obviously a lot more focus on CapEx efficiency, so spending wisely. There's a great focus on return on investment. Much more considered investment decisions are being made. Again, as you can see on the slide, the old mantra of build it and they will come, I don't think really exists anymore. There's a much greater trend towards whole life cost assessment, so achieving value for money is absolutely critical. There's a strong focus on post-construction costs as well, so there's a big drive towards FM and operational efficiencies. And there's increasing globalization as well, so I think we've probably all been made aware of the increasing prominence of the Asian market with the UAE and with the Middle East. So you see lots and lots of Chinese banks here in the DIFC, Lots of Chinese and Korean contractors are in the market now, and they historically have been, but more and more they're becoming more prominent. So if you look at the region's first nuclear plant in Ruwais as a great example. And there's obviously political linkages as well, trade links between the UAE and Asia, which is borne out by the UAE and Asian Investment Fund. So clearly, there are political links and political drivers to attract investment into the region from Asia. We talked about the oil price earlier. There has been some form of stabilization, and that's clearly affecting the market in a positive way. There is a lot more, there's improved market sentiment and improved conditions. And moving forward, if $50 per barrel is the new norm, it gives people confidence to invest and to deliver projects. And clearly, although governments are reassessing their priorities, they are still spending money. They are still looking at ways to raise debt, either through PPPs, bond issuance, etc., in order to keep driving and delivering those projects. Again, according to Mead, and I said this 2 or 3 slides ago, although year on year we are 13% down between year to date and Q2 2015, 13% in itself is actually relatively modest, and that could arguably point towards a more maturing economy. And so whilst 2016 has proven to be challenging, and that certainly applies to us at Deloitte as well as I'm sure everybody else in this room, I think there is some cause for optimism as we head towards 2017 and beyond. Thank you.